What if the price flashing on your screen right now is completely made up? Not a rounding error, not a momentary delay, not some innocent little digital hiccup buried in the pipes of modern finance. What if the number you see when you pull up silver on your trading platform, on your brokerage app, on every single financial website you trust, has absolutely nothing to do with the real price being paid for physical metal on the other side of this planet at this exact moment? Because right now, at this very second, someone in Shanghai is reaching into their pocket and paying $101 for a single ounce of silver, real silver, metal you can actually hold in your hands. And someone in New York is being told with a completely straight face that the same ounce is worth $89. That's not a discrepancy. That's not a time zone lag. That's not an innocent difference in local premiums. That is a $12 confession printed in plain sight across two exchanges. And not a single anchor on financial television has the courage or the curiosity to ask the most basic question any journalist should ask. Why? Why does the same metal cost $12 more when actual buyers are involved? Why does the price only collapse in the market where paper contracts outnumber physical ounces by multiples that would make a casino blush? OG John AG. Raw data and integrity. This is OG John AG. And before we go one single sentence further, let me make something crystal clear for anyone who just arrived. I sell nothing. Not a course, not any kind of hidden charts or secret numbers, not a premium signal group, not a newsletter behind a paywall, not a mentorship, not even a coffee mug. Zero. The raw data and full analysis lives here on this channel. That is the entire operation, and it will never change. Now, if you've been paying monthly subscriptions to those metals gurus who package their insights in glossy PDFs and premium Discord servers, I need you to understand something. They're in here right now watching this, taking notes, reformatting what you're about to hear into content they'll charge you for next week. That's not speculation. That's a pattern I've watched repeat for months. Copycats cloning the format, borrowing the framing, sometimes even lifting the exact data sequences. OG John AG 2.0 on YouTube. That's the source, and the only real channel where real data lives. Everything else is a photocopy of a photocopy. If what you hear in this video changes how you read these markets, subscribe and drop OG John AG 2.0 below so I know exactly who's locked in. Because what I'm about to lay out over the next 20 minutes is something most of those paid services won't go anywhere near, not because they can't understand it, because explaining it honestly would contradict the simplified narrative they've already sold you. The Wednesday CME halt, timeline and details. 48 hours from now, March settlement begins on COMEX. And what happened on Wednesday afternoon in the middle of a live trading session wasn't a glitch. It wasn't a hiccup. Whether it was an accident or something far more calculated is the question you should be turning over in your mind for the rest of this week. By the time I finish, you'll have every single piece of evidence required to reach your own conclusion. And that conclusion, whichever direction it points, will be built on data, not hope. Let me reconstruct exactly what happened, minute by minute, because the timeline matters more than any headline summary. 12:15 Central Time, Wednesday afternoon. Silver futures are trading at $91.30 on CME Group. The price is climbing. Momentum has been building for days. We identified $92 as the next critical resistance target in previous analysis, and the market was pushing directly toward it. Buyers were leaning in. The volume was healthy. The chart looked like potential energy converting into kinetic energy, right in real time. And then, without a single warning, every metals and natural gas futures contract on the CME went completely dark. Not slow, not laggy, not partially functional, fully halted. No bids, no asks, no price discovery, no trades, just a frozen number on a screen while the rest of global finance kept moving all around it. Natural gas came back online at 12:50, 35 minutes of downtime. Metals stayed silent until 1:45 minutes. Some sources measured it closer to 100. Let the weight of that settle. The largest, most liquid, most heavily traded metals futures exchange on the face of the earth went completely catatonic for an hour and a half, while silver was within striking distance of a breakout level, 48 hours before one of the most consequential delivery windows of the year. Systematic order book deletion and algo advantage. The official explanation from CME Group. Technical issues. 2 words. No elaboration. No detailed postmortem. No explanation for why natural gas recovered in 35 minutes while metals required nearly triple that time. Just technical issues, and a reopening that felt less like a recovery and more like a complete reset. Because when those gates finally lifted at 1:45, what followed wasn't a correction. It wasn't an orderly repricing. Silver dropped $3 full in minutes. $91.30 to $88. Vertical, no pause, no bounce at intermediate support. No bid stepping in to absorb the flow. Just a solid wall of selling pressure that detonated the instant the very first trade was permitted to execute. Gold took an identical hit. $70 vanished. $2,564 became $2,500 before most retail traders even finished reading the headline about the halt ending. This wasn't the behavior of a market catching up to missed information. This was the behavior of a market being forcibly relocated to a lower price. And the selling itself isn't even the part that should concern you the most. What CME did to the order book during those 90 dark minutes is where the real story actually lives. During the halt, CME systematically canceled every single day order and every good till date order sitting in the system, gone, erased. The only orders that survived were good till canceled orders that had already received acknowledgement before the freeze began. In practical terms, what does that mean? It means every retail trader who had a carefully positioned buy order, a limit entry at support, a protective stop, anything with a time component, all of it was deleted. The entire order book was stripped completely clean and rebuilt from scratch. And who thrives in a freshly emptied order book? The institutions running algorithmic execution systems that can repopulate thousands of orders in the time it takes a human being to click a mouse. The hedge funds with co-located servers and direct market access who don't even need 10 seconds to process a reopening. Not the individual trader sitting at a kitchen table trying to figure out why their stop loss didn't execute and their limit order just disappeared. Pattern recognition. Second disruption in 21 days. Now hold something in your mind, because the answer is coming. But I need you to sit with the question first. If Wednesday was a genuine, isolated, random technical failure, why is it the second major CME disruption in 21 days? 5 years, half a decade of clean, uninterrupted operation, not a single major outage worth reporting. And then concentrated into February alone, 2 significant failures. The first week of the month, settlement prices across multiple contracts were delayed in a way that created confusion and forced manual reconciliation. And now a full trading halt that froze the entire precious metals complex for 90 minutes at the worst possible moment for anyone holding a long position. 2 disruptions 3 weeks apart, both occurring while silver was building momentum toward levels that would increase delivery pressure on concentrated short positions. Remember that pattern? I'm coming back to it with historical evidence that will completely reframe everything. COMEX vault data, registered inventory drain. Let me pull back the curtain on the vault data, because what's happening beneath the price chart makes the surface action look like a distraction. On Tuesday, a single trading day, COMEX registered silver declined by 2.2 million ounces. I want to break that down vault by vault so you feel the weight of each withdrawal. Asahi saw 155,000 ounces pulled from registered Brinks, had 167,000 adjusted out. HSBC, the bank that has sat at the center of precious metals clearing for decades, lost 647,000 ounces. JP Morgan, 374,000. StoneX, 80,000. Some metal did move into Loomis registered inventory, partially offsetting the outflow, but the net result was still 890,000 ounces, leaving registered status in just 24 hours. Total COMEX registered silver now stands at 86.3 million ounces. And that number has been declining, not sporadically, not occasionally, but persistently session after session, week after week, with almost no counter-trend replenishment. Registered silver is the metal physically designated and legally available for delivery against futures contracts. When that pool shrinks heading into a settlement window where open interest remains elevated and delivery notices are about to start flying, you get exactly the kind of structural tension that makes exchange operators reach for the emergency brake. Whether they actually pulled it on Wednesday is the question. That the conditions existed for them to want to is not in dispute. March rollover and missing physical replenishment. Now yesterday something happened that appeared to relieve the immediate pressure. 71 million ounces of March silver contracts rolled forward into later delivery months. That is the single largest one-day roll we have observed. On the surface, it looks like a pressure valve. Shorts who were facing potential delivery obligations against March contracts bought themselves time by pushing those obligations into May and July. The immediate March squeeze scenario became less acute overnight. But here is the piece that nobody is discussing, and it changes the entire equation. Where is the replacement metal? Obligations rolled forward, fine. Immediate delivery pressure deferred, understood. But what is conspicuously, glaringly absent from every data source I've checked is new physical silver entering COMEX vaults to replace what has been steadily walking out the door. Eligible inventory sits on the books, yes, but eligible is not registered. Eligible means the metal is in the vault. Registered means the metal has been offered up for delivery. That distinction is not academic. It is the entire ballgame. Counting eligible silver as available supply is like counting the cash in your neighbor's wallet when calculating your own net worth. It exists. It's physically nearby. It is not yours to spend. And right now the metal that actually is available for delivery keeps leaving, while nothing new shows up to take its place. Shanghai Premium, real demand versus artificial price. In a moment, I'm going to show you something from the gold market that should not be possible this late in the settlement cycle, and it connects directly to everything I just laid out about silver. But first, let me take you 12,000 kilometers east. Shanghai spot silver is trading at $101. Shanghai Futures Exchange silver sits at $106. Western spot sits at $89. Run those numbers. The Shanghai spot premium over Western spot is $12 per ounce. Compare Shanghai futures to Western spot and the gap balloons all the way to $17. That premium has not collapsed during Western sell-offs. It has not narrowed when CME prices dropped, it widened. When silver fell $3 in New York on Wednesday afternoon, Shanghai didn't even flinch. The premium held and actually expanded. That behavior tells you something that no amount of paper trading can disguise. The market where physical metal actually changes hands is paying significantly more than the market where paper representations of metal trade in volumes that completely dwarf actual available supply. When that divergence persists through a disruption event and widens rather than corrects, it isn't temporary arbitrage. It's a structural confession about where real demand lives and where artificial pricing is being maintained. And Shanghai is reinforcing that message through enforcement actions that deserve far more attention than they're currently receiving. The Shanghai Futures Exchange suspended 25 separate trading groups in February for violating position limits, 25 in 1 month. That is not routine compliance housekeeping. Exchanges enforce position limits aggressively when concentrated positioning threatens systemic stability. When you see that level of enforcement intensity on one side of the world while the other side experiences its second trading halt in 3 weeks, you are not looking at coincidences. You are looking at different manifestations of the same underlying condition. Physical demand is testing the structural limits of the paper framework built to contain it. The gold market anomaly, undelivered contract. Now here's the gold market anomaly I mentioned, and this one genuinely caught my attention. The February gold contract, which by every normal measure of settlement behavior should be almost entirely closed out or rolled by this stage of the month, still shows 4,000 open contracts. 4,000 contracts represents 12 metric tons of gold. At current market prices, that is approximately $2 billion worth of metal that one party is obligated to deliver, and has not delivered. February is functionally over. Those contracts were opened at the beginning of the month. Standard practice clears or rolls the vast majority of delivery month contracts well before the final days. 4,000 still standing this late is not a paperwork backlog. It is an indicator that someone somewhere in the clearing chain is struggling to source 12 tons of physical gold against their contractual obligations. And if gold, the deeper, more liquid market, is exhibiting delivery strain, what does that tell you about silver? Where registered inventory is smaller, where industrial demand is inelastic and growing, and where the largest producing nation on earth is dealing with deteriorating security conditions. That producer is Mexico, still the world's dominant source of mined silver, and the situation on the ground is not improving. Cartel-related violence continues escalating in key mining regions. Transportation infrastructure faces increasing disruption. The ability to attract and retain skilled labor in high-risk zones is degrading. Operational costs are climbing. The Trump administration's coordination with the Mexican government may eventually stabilize conditions. But right now, in this moment, supply risk from the planet's most important silver source is intensifying, not receding. Mexico mining risks and ETF inflows. Let me show you one more data point that ties the futures behavior to a larger risk migration. COMEX open interest in silver is declining. Money is physically leaving the futures market. At the same time, SLV, the largest silver-backed ETF, is recording consistent daily inflows. That is not random capital rotation. That is deliberate risk repositioning. Traders are choosing to pay the ETF management fee and accept ETF tracking error rather than hold a futures contract that theoretically guarantees delivery. You do not abandon the more capital-efficient instrument for the less efficient one unless you have concerns about whether the efficient instrument will actually perform its core function. When sophisticated market participants start preferring ETF wrappers over direct futures exposure, the futures market has a trust deficit, and trust deficits in leveraged derivative markets do not heal gradually. They rupture. Now, I owe you the bearish case because intellectual honesty demands it, and because anyone who only feeds you one side of the argument is not educating you, they're recruiting you. The bearish case. Mechanical failures explained. Scenario 1. Wednesday was exactly what CME said it was. A technical failure, nothing more. Exchanges operate enormously complex real-time infrastructure. Components fail. Natural gas markets have simpler clearing mechanics and recovered faster. Metals required additional verification layers, more complex settlement checks, and the 90-minute timeline reflected procedural caution, not strategic intervention. The $3 price drop upon reopening was a textbook stop-loss cascade. Leveraged long positions accumulated during the rally to $91 got mechanically liquidated when the market gapped lower on reopening volatility. No coordination necessary, just algorithms executing pre-programmed liquidation triggers in a thin post-halt order book. The order cancellation was standard risk management protocol during an extended outage, consistent with CME's published procedures. The 71 million ounce March roll absorbed the delivery pressure that was building. Shorts can continue rolling into May and July. The Shanghai premium could narrow as conditions stabilize. Mexico's supply disruptions could ease. Eligible inventory inside COMEX vaults, while not currently registered, can be converted rapidly if price incentives make delivery economically attractive. Every single data point I've presented has a mundane explanation. The bearish case is not irrational, it is mechanically coherent. And dismissing it reflexively would make me exactly the kind of biased narrator I criticize others for being. But here's why history suggests the bearish explanation, while valid in isolation, is incomplete when you see the full pattern. Historical lessons. The November cooling issues. November 28, CME halted silver trading, not for 90 minutes but for 10 hours. 10 full hours of darkness on the world's primary silver futures exchange. The official reason was cooling issues, infrastructure overheating. Silver was trading at $53.26 when the screen went completely black. That halt landed directly on first notice day for December silver contracts. Reports emerged, not from conspiracy channels, but from institutional trading desks, that a Chinese industrialist had formally notified COMEX of intent to take physical delivery of 30 million ounces. 30 million ounces against a registered inventory that could not absorb that volume without visible distress. When trading finally resumed after that 10-hour blackout, silver spiked to $56.78. Within 60 days it had more than doubled, past $121. The cooling issues were never the story. The delivery pressure was the story. The halt was the body's fever response to an infection it couldn't fight with normal antibodies. And when the fever broke and the infection remained, the price did what suppressed prices always eventually do when physical reality overwhelms paper mechanics. It moved violently to reflect truth. Map that exact template onto Wednesday. Silver approaching $92. COMEX registered at 86.3 million, and declining daily. Shanghai premium at $12 and widening during Western weakness. March settlement 48 hours away. February gold showing 4,000 open contracts with apparent delivery strain. 25 SHFE suspensions indicating concentrated positioning at dangerous levels. And precisely at that intersection of converging pressures, the exchange goes dark for 90 minutes and reopens to a $3 waterfall that resets momentum, clears stops, and empties the order book. The November pattern didn't predict the subsequent price explosion because of the halt itself. The halt was irrelevant to the trajectory. What mattered was that the conditions which prompted the halt were real. The physical shortage was real. The delivery pressure was real. The concentrated short positioning was real, and none of those conditions resolved because of a 10-hour pause. When they persisted through the reopening and into the following weeks, the price moved to reflect the reality the halt had temporarily obscured. The conditions present today have not resolved either. Market infrastructure and physical realities. The roll moved obligations forward but created zero new supply. Registered inventory continues declining. Shanghai continues paying double-digit premiums. Mexico's supply infrastructure continues deteriorating. The February gold delivery anomaly remains open and unexplained. The migration from futures to ETFs continues accelerating. Jesse Livermore wrote something in reminiscence of a stock operator that has survived a full century because it describes a truth that never changes. The insiders who control market infrastructure will always hold a structural advantage over outside speculators. When you control the exchange itself, you control when the game is played and when it pauses. A well-timed halt accomplishes what direct selling pressure cannot. It breaks momentum. It triggers cascading liquidation. It resets the playing field. It hands every advantage to the participants who can react in microseconds while everyone else is still reading the notification that trading has resumed. Whether Wednesday was that kind of strategic intervention or a genuine mechanical failure, the math underneath has not moved one single millimeter. 86.3 million registered ounces falling daily, 71 million rolled but zero replenished. 4,000 February gold contracts undelivered. $12 Shanghai premium holding through Western disruption. Open interest migrating from futures to ETFs. 25 SHFE suspensions in a single month. March 1st notice day now less than 48 hours away. Here's what I need you to do. Not as investment advice, not as a directive, as a challenge to your own intellectual honesty. Pull the COMEX vault reports yourself. Check the Shanghai premium against Western spot in real time. Look up February gold open interest and verify the 4,000 contract anomaly. Read the SHFE suspension notices from February. Every single data point referenced in this video is publicly available. Free, verifiable, sitting right there waiting for anyone willing to spend 20 minutes confirming or denying what they just heard. Most won't. Confirmation bias is the most powerful sedative ever invented. People would rather protect a comfortable belief than test it against data that might demand a new conclusion. They would rather dismiss an argument than verify it, because verification carries the risk of being wrong, and being wrong requires the effort of changing. That's human nature. It is not a flaw to be ashamed of, but it is a limitation to be aware of. The ones who do check, they never need convincing from me or anyone else. The numbers do the work. I just make sure those numbers reach people willing to look at them without flinching. Closing summary. Logic over hype. If this changes how you see what's unfolding in these markets, hit the like button. Share it with someone who still believes the paper price is the final word on what silver is worth. Subscribe if you haven't, because when the next disruption hits and the structural data says another one is coming, this channel is where the breakdown lands first. Unfiltered, unsponsored, and free. If you made it to the end, drop OG John AG 2.0 in the comments. Not because I'm counting, because it tells me you sat through every uncomfortable data point, every bearish counter-argument, and every question this video raised, and you're still here. That's the audience this channel is built for. This is financial warfare education. It is not investment advice. Invest with logic, never with emotions, never with impulse decisions. Be smart, stay vigilant. OG John AG signing out. The vault numbers don't lie. The people guarding them might.